Softbank, for those of you who aren't aware, is the Japanese technology group that's been shaking up the tech industry with its $100 billion vision fund, which includes backing from Apple, Qualcomm, and Saudi Arabia. Now it's said it's going to raise a fund like this every few years. So joining me to discuss that, we have Peter Wagner, who is the founding partner of Wing, formerly of Accel, and has written a fantastic blog that I suggest you guys check out later about aircraft carriers and Death Stars in the venture industry, which hopefully he'll explain for us in a second. Hunter Walk, who makes investments at Homebrew and interesting blogs also at hunterwalk.com. I particularly liked your recent one on correcting gender bias in funding. And Mike Gridley at Acadian Ventures, who invests in growth stage companies providing alternative liquidity for entrepreneurs and early investors. So thank you all so much for joining me. This is, to me, by far the most interesting topic in venture capital at the moment. And I wanted to start, obviously we're going to talk a lot about this from the investor's point of view, but I wanted to start, if you're an entrepreneur and Softbank turns up on your doorstep with, you know, at very least a couple of $100 million in their pocket, what should you do?
Well, I mean, there's a lot of entrepreneurs asking themselves that question, you know, over the past couple of years, or even as we sit here right now. We've had certainly that come up within the Wing portfolio as well, and you know, I think there's a number of considerations, and it's complicated by the fact that you then have board members with very different views of it as well, many of whom are obviously investors and have their own lens on whether the SoftBank effect is good for their business, not necessarily just the portfolio company's business. So I think, you know, the conversation is happening at many levels, not all of which are clearly stated.
Yeah.
I think, you know, there's really two types of these SoftBank rounds in the marketplace we've seen so far. There's the into Uber, right, where it's a company that is already growing and existing off of growth stage capital, and where the financing is a mixture of primary and secondary and a whole bunch of structure. And then there's some of the earlier stage where, you know, reportedly, you know, the sort of the WAGs, the brandless. I think you might be. I'll just talk loudly.
Or just pick the chair just for a moment. I'll take it from you.
The WAGs, the brandlesses, were, you know, reportedly they're sort of you know, a near majority ownership, a lot of board seats. I think those look more like M&A discussions if you're a founder, more than you know, a Series B, Series C capital. You're essentially trying to decide, you know, a private equity firm has approached you and wants to become your partner in your business, and you're trying to make the decision whether you know enough about what you want to build and you know enough about that potential partner to make that decision. Because in a lot of cases, for all intents and purposes, the existing cap table is going to go along for the ride. You know, the amount of money being thrown into some of these early stage companies is significant enough that you know, they're turned into you know, passive shareholders in some cases.
Yeah, I think one of the big things in the last couple of years, I mean, it's just not just SoftBank in the SoftBank rounds, is you're seeing the entire late stage growth market change pretty dramatically, and the amount of capital that's come into the late stage. So yes, SoftBank's probably writing the largest check, but you have sovereigns that are showing up, and then all the traditional crossover funds, the T. Rowe's, the Fidelities, the Wellington, the Ballygifford out of the UK, that are showing up and writing $50 to $100 million checks. And it's really changed the dynamics, I think, at the late stage of growth. And to Hunter's point, where it really starts to get interesting and we see some perverse side effects is when those firms migrate downstream and start to get in at the Series B or the Series C. I mean, you know, historically, folks like Tiger and DST would only show up in Series D or Series E or F, kind of 6 months pre-IPO. Now you're seeing them lead Series B deals that are both primary and secondary. So that's started to really change, I think, the overall landscape and dynamic.
Yeah, I mean, you know, I actually think SoftBank is a symptom, not a cause. And it's just a symptom of capital market supply and demand. You know, there is an avalanche of capital that wants to invest in venture stage companies, interesting private technology companies. Masayoshi-san was smart enough to figure out a way to scoop that up, to his benefit. But he wasn't the first to do this. As Mike just said, he may be the most extreme expression at the moment until the next one. I think it's a little ironic that some of the complaining is coming from folks that were just playing the same game previously. And they've been outdone, and it's like, oh, you can't do that. That's not fair. It's like, well, hey, this is just a continuation of a trend, which is really just driven by the never-ending cycle in the capital market.
And is it also partly the speed at which SoftBank's doing this? Because it seems like there's been several cases where you see someone perhaps being offered an investment, and then if they don't take it, they go straight to their rival. Is that the problem for some entrepreneurs trying to make their minds up? That it might just be that they then have to compete against SoftBank money?
I mean, I think as Peter said, that's been happening in some fashion over the last few years in these land grab, perceived sort of winner take most markets, right? If you're doing last mile delivery and your competitor raises a $50 million round and uses that to subsidize their cost structure, you have to decide whether you're going to sort of, keep your unit economics like they should be and sort of be the tortoise, or whether you're going to, try to turn into a hare. Now we're just taking that up an order of magnitude in some cases, which you can decide whether that's good or not. This is not our investment strategy, but if you gave me the ability to sort of index the competitors in some of these early stage SoftBank financings, I might invest into the people who didn't take the money. I think there's a lot of risk being put into absorbing a few $100 million very quickly from an investor who, we'll see if the 100-year, 200-year plan makes sense. But what they essentially, in order to get the returns, even a 2x off a $100 billion fund, you need to have category killers in any category that'll support a killer. And so taking a dog walking business is a statement about what's going to be your wedge into owning the pet market. And there's going to be, a lot of need for growth, a lot of need for, potentially vertical integration, acquisition. You're turning an operating vehicle into a financial vehicle. And, maybe it's my bias as an early stage investor anyway, because I'm not working off of spreadsheets, I'm working off of teams. But show me an investor, show me a founder who turned down that large a check, and I might want to write them a smaller one.
I think you're getting right to the crux of the distortion, which is there's just a clash of business models here. There's two basic business models in venture investing, and let's just call whatever SoftBank's doing venture investing. Just humor me with this for a minute. But the classic business model is based on cash returns, and it's invest early. Create a lot of value along with the teams, create a company that matters and benefit. And there's a lot of alignment between the investors and the teams if that's the business model. Given the overwhelming supply of capital trying to get into this phase of the ecosystem, another business model has shown up, which is an assets under management business model. And this is all about capital deployment. Returns are a secondary consideration. You need good enough returns in this business model to be able to keep raising more money, i.e. another vision fund a few years later. And if your business model is about capital deployment, then you're just looking for places to park cash. Value creation is not the main event. And so I think the distortive effect here is that we've had this business model start to become a really big consideration in the entrepreneurial community, and there's a fundamental misalignment between the capital deployment business model and the cash on cash return business model.
And can they coexist?
Uneasily. I don't think we've been here before, right? Because even later stage venture investors have generally been about cash on cash return. Perhaps with more of a time-based metric in there. But the idea that I'm just putting money to work and it's capital deployment only, where have you seen that? Like governments? It's not. It's a bit of a new thing, and I think the consequences aren't fully understood.
Well, and I think that's a great point as far as we really are breaking new ground as far as just the overall scale. To give you some idea, I think it was last year, the entire, according to the NVCA, the entire venture ecosystem was 84 billion put to work. So you have SoftBank showing up with 100, trying to put 50 to work every single year, not to mention the Sequoia with their 8 billion, and you just go down the list. It really is unprecedented. And now the caveat here is that that's just US based. And on the global scale, you're seeing a lot more activity in Asia and India and in Europe. And you see unicorns. I mean, there used to be 50, and then it was 150. Now it's over 200. And I think it was 20 or 30% of the funding just in the US last year went towards billion-dollar plus or greater valuation companies. So this whole notion that you'll have hundreds of unicorns and they will persist and they will not go public and they will still stay private has really never been seen before. Definitely not at this scale and not with these dollar amounts.
Yeah, to the question of coexistence. I mean, we all know people who work at Softbank. They seem to be very nice people. I don't have any co-investments with them right now.
I wasn't suggesting that.
I may in the future, but you know, everyone talks their book, right? So if you want to make the case that deploying these large sums of money and having, you know, because you have a century-long vision that makes you more entrepreneur-aligned, well, you know what? Take common stock then. If you want to really be entrepreneur-aligned, if you want to be aligned with the team, take common. And I'm saying that as somebody who, like, as a seed investor, I take preferred, right? So I know that, you know, I'm talking my book too of like, what's the risk reward on the capital that I need to put in an early stage. But if you're going to put in late stage capital and you're going to create structure, you know, just call it what it is. It's an alternative to the public markets. And so the solution to some of this stuff isn't 10 other $100 billion funds. It's getting more companies public because the public market can absorb more than any one private investor.
Yeah, and so you mentioned WAG earlier. There's been reports that SoftBank has a whole series of different preferential treatments there. How unusual is what SoftBank is asking for in some deals?
I think, at least in our experience, I mean, when you start to see late-stage pre-IPO growth rounds, it's not uncommon to see a liquidation preference. It's not uncommon to see kind of an anti-dilution ratchet. Again, it's just a function of what is the entrepreneur or founder solving for? Is it the headline number, in which case there's typically a lot more structure involved, or are they taking the lower term sheet that's a clean term sheet? So it's not uncommon. It's more just a product of the stage.
I wanted to pick up on something you said earlier. You were talking about, you know, in the US, the VC market, but you are starting to see more investments elsewhere. Do you think this amount of money will actually sort of galvanize the VC markets in other places? I mean, the differential is still huge between the concentration of money in Silicon Valley and how it goes to companies in Silicon Valley.
That's a great point, and I think you've already seen that this year in the first half of the year. If you look at just the number of Chinese-based IPOs that have listed in the U.S., it's staggering on a relative basis compared to U.S.-based companies, especially when you get into the internet sector, and they've really been driving massive amounts of liquidity and value creation. Now, time will tell if those values sustain, but yeah, I think you're truly seeing the globalization of venture, unlike you've seen ever before. I mean, in the first half of this year as well, you had 3 exit events in Europe that were multi-billion, and that's never happened before. So you're starting to see markets that historically were underserved by capital. Now, if you're generating 10 or 20 million of revenue anywhere in the world, venture capital money will find you.
So just to say that in about 5 minutes, I'm going to open it up to Q&A. So if you want to use the website that's up here, slido.com, I think someone will be able to show me the questions. So let's see. We'll hope to see if that works. Yes. Okay. I have an iPad for that. And so, you know, what is the impact on the entire tech industry? Some people worry that SoftBank is basically propping up a bubble that they've been waiting to pop for years.
Yeah, I don't know if it's propping up a bubble. I think it's a symptom of a bubble, or at least bubble's even is a loaded term. I mean, it's a symptom of an acceleration phase of a market, which will continue until it doesn't. Exactly. I'm glad somebody laughed at that. We all know the market will turn. It's a cyclical business. It's a boom-bust industry we're in. If you don't believe me, let's talk in a few years. None of us know when, though, right? It's like, oh, yeah, it'll turn. I don't know when. Okay, so what do I do about that? Business as usual, I guess. So I don't know if it's propping it up or whether it's just sort of a creature of the times. I do think there's some really, really pronounced effects both on the companies, which we've spoken about, but also on other investors, which some of whom will feel motivated to try and keep up with the Softbanks. And
do you think that's the right strategy?
It's a strategy. It's certainly not the strategy that we've embarked on at Wing, but I think for some who are very attracted to the assets under management, capital deployment business model, they'll see this as just the pretext required to go and take that to the next level. Some may be equipped to manage that. I think most won't be. So that could end badly. But the ripple effects will be significant.
Okay, we got a couple of questions coming in.
Are they good ones?
Well, one of them is one that I think I already asked, but I like to ask questions twice because you might get more interesting answers. So how should founders deal with the fear factor that if you don't accept a giant round, Softbank will overfund your competitor?
99.9% of founders shouldn't worry about that. They're not going to get offered $300 million. Build your business. I mean, look, realistically, I think it's a question about, like I said, think about it as co-ownership. Think about it as a massive reduction in optionality, but a increase in resources to make one very particular bet, and be sure that you understand fully the trade-offs you're making. We're all adults, so these are all trade-offs and probabilities. As a very early stage investor, and I've only been doing this 6 years or so folks like Peter have a lot more experience than I do, but it's fun sort of managing this, kind of helping folks think about playing offense while also trying to maintain a realistic view of probabilities, right? So if any entrepreneur properly calculated the odds of their company succeeding, they wouldn't start their company. But yet we all do, and we all line up to back them because we know that some percentage are able to create really, really significant businesses. And capital doesn't make the business. Different types of businesses, succeed or require different amounts of capital at various points in their life cycle.
We've got quite a few coming in now. So with quality secondary markets emerging and large amounts of primary capital available, do we even need public markets anymore? I mean, I imagine some of the existing public companies would challenge that. They're maybe not Tesla.
Yeah, I mean, I think just this year you've seen a big rush of Chinese-based companies listing in the U.S. even more so than U.S.-based companies. I think the availability of late-stage capital means that you can stay private for very, very long, but it's TBD whether or not you can have kind of a permanently private company. I think there's just a lot of dynamics at play, and depends on what industry you're operating in. It just makes people nervous to some degree, but there are companies, I mean, SpaceX is a great example, or even Palantir, that are on this kind of multi-decade timeline, which doesn't really line up with the traditional fund structures of a 10-year life, 2-year extension.
But even with a Palantir, they kind of go back and forth, it seems, on whether they want to go public because of the employee issue.
Yeah, and I think, I wouldn't necessarily hold up that situation as being a great one to emulate, because I think companies have tried to have, on a regular basis, points of liquidity for all the shareholders. I think SpaceX is probably a better example of the multi-decade type vision, and you want to be able to onboard investors and provide liquidity at some point, and that's just a big, huge, audacious goal. I think companies with a more narrow focus that fit into the traditional timeline, I think there's a penalty for not being a public company at some point.
So one of the questions I think is directed at you, Hunter. It says, it's clear Hunter is not a fan of startups taking Softbank funding. What opportunities do you
When they include
see?
secondary, I'm a huge fan. No, it depends. It depends.
What opportunities do you see with SoftBank's approach that are positive?
Oh, yeah. Like I sort of said, I knew I was, needed to say some stuff to, not make this sort of just, a lukewarm milk panel. And so,
It's never going to be that.
Yeah, I have not with your moderation. I have. I've been exposed to the people, but not the process, right? And so I think when startups should be constructing cap tables that believe in their companies beyond sort of the chilling effect of, what happens if my competitor raises $200 million. You should be able to turn to, sort of a board, including independent directors, that's going to give you, sort of advice on behalf of the company. And I think, it remains very much TBD for this earliest set of experiments, what a few $100 million do this early in their life cycle. And we won't know that for another 5 to 10 years. I think the late stage is very, very real, is likely very positive for the ecosystem, while I also think that we need to create sort of more pathways to public markets. And so in those cases, I don't think there's as much of a distortion effect. I think it's, matching what's been happening the last few years with sort of private IPOs anyway, and you sort of rotate from like the hedge funds to the sovereign wealth funds to something like Vision. But the early stage is an experiment, and anybody who tells you otherwise, is fooling themselves or fooling somebody else.
So I'm going to end with this question. It says, in 20 years, does SoftBank exist in a similar way? Are the Sequoias still raising huge funds? How does it change and why?
Well, I think if we look at the last 20 years, there's been a pretty pronounced evolution of the venture industry. If you go back to 1998, most of the leading venture firms were single product vehicles focused on US venture capital, investing funds that were, a couple $100 million in size. And then since then, there's been this evolution, which I know I have called the aircraft carrier effect, where they have advanced on at least 2 dimensions. One is just raw scaling of bigger funds, more assets under management. The other is a proliferation of strategies under the same banner. So international funds, growth funds, sort of distinguished by stage, sector-specific funds. And so the result is both bigger and more complex investment organizations. And, Sequoia, the questioner mentioned Sequoia. Sequoia's always been the trendsetter. They've always been the firm that everyone else is following. And Sequoia certainly was the early innovator on a bunch of these things. They had a growth fund before anybody did, in the mid-90s even, or even the early 90s, I think was the first one. And international expansion, et cetera. And the rest of the industry has tried to follow along with sort of Sequoia envy, trying to keep up with that. Where does that go for the next 20 years? Is SoftBank going to trigger, are they going to be the leader for the next round? Are people going to emulate that? I don't think so. I think Sequoia will continue to occupy that socket, but they are going to respond if they think they're put at a disadvantage by sort of massive capital availability. They're going to add that arrow to their quiver, and they'll do it well. Will the rest of the industry follow? Should they follow? Will they be able to follow? I think that's an interesting aspect of the question. I personally think that we're going to find that these massive capital infusions at too early a stage are actually very negative, and nothing can, sort of really be sort of more damaging in some ways to a promising early stage company than to give it so much cash that it no longer has to make choices. And so now instead of doing A or B, I'm doing A and B, and I'm also doing C. And some of the stuff that has really been part of the secret recipe around value creation in the startup world starts to get lost. around early stage, I'm somewhat skeptical. The later stage stuff, it's a very different business. There's always been lots of capital available for later stage companies. It's just the definition of lots is evolving. But you know what? The percentage of our economy that is dominated by technology or touched significantly by technology is also increasing too. So it may in fact just be a proportionate growth that we're seeing there.
Okay, we're running out of time, so if you guys have your one sentence prediction for 20 years' time to finish off with, that would be great.
Well, I think it goes back to something earlier. I think there's going to be more and more companies that, if they stay private a long time, they're essentially going to be co-owned by the founder/team, the common stock, and a smaller number of core investors that tend to own double-digit or more percentages. Sometimes that'll clean up the cap table, but it'll also clean up the sort of governance structure and allow them to operate outside of a traditional fund timeframe.
I think back to Peter's point, the cash-on-cash return focused funds versus the AUM focused funds. I think the potentially Softbank survives and continues and thrives in 20 years' time. I think you may have Sequoia has always been a leader and innovator, but I do think that having dozens of funds that are $1 billion plus is kind of a recipe for disaster, and we've seen that before in the retrenching and kind of the first Internet 1.0 boom. I think it's more global now, so you can make an argument for deploying capital on a global scale, but I think there's a reason that lots of firms just try to stick to their knitting and focus on small cash-on-cash return generating alignment with founders as opposed to asset gathering and collecting.
Well, thank you all very much. Thank you guys for your questions. And I think we live in interesting times.